We've got the legendary Karlton Dennis here that's going to give us a great rundown on how to save thousands of dollars in tax if you are a trader and or investor. So Karlton, welcome. Can you give us a quick background? I know we're on a yacht in the Zumas, but maybe we avoid this beautiful view for the sake of the value in this video. Can you give them a quick background on just how you've developed as a professional and who you really help to serve on the tax side of things?
Yeah. For many people that don't know my story, I did not go into taxes initially. I did not go to school for accounting. My mother actually owned a tax and accounting firm for the last 30 years, and I happened to intern when I was 16 years old in her office. And I went on to play sports, and then after sports was all over, I decided to join the family business and learn that there was a need for tax strategy to be dispersed online. And so what I decided to do is start a YouTube channel. That YouTube channel has grown since to 550,000 subscribers. I'm a licensed enrolled agent now, and I serve business owners and real estate investors across the United States in all 50 states. I love what I do.
That's awesome. So the main thing, there's so many areas of tax and asset protection that you work in. Let's kind of specifically talk to the investor and trader. And let's say that they have some capital gains. Maybe we're talking anywhere between $10,000 up to a couple $1 million in capital gains.
Yeah.
So there's a few things that you can do on the tax side specifically, and then we'll briefly touch on asset protection too. Yeah. But on the tax side of things, let's say they have capital gains, right? They can be in a job or they have their own business. What is an exemption or something that people could take advantage of to help save them thousands of dollars on taxes?
Yeah, so when you're starting out in investing, you'll learn that the government only allows for you to claim like $3,000 in losses against your income that you have for capital gains, which, let's be honest, that's not enough, $3,000. So you'll start to do some research. You might come across this election, and this election is called the mark-to-market election. And essentially what it is, it's saying to the IRS that you're selling all of your securities at the end of the year and claiming it as ordinary income, but you get to experience all of your losses that you might have had throughout the year. So as you start to develop as an investor, as a trader, and your account starts getting bigger, you're going to experience bigger losses. You're going to use those losses to offset bigger amounts of income, reducing your overall tax bill. And that's what we do. We start looking at the mark-to-market election, and even more so, Jeff, we'll start looking at setting up entity structures and treating traders like real business owners.
So they can write off like the mark-to-market, that helps them just write off the losses? Or like, what about the commissions and the fees and on each trade, any expense that goes along? What about like computer equipment?
Yes.
And like stuff like that. So everything's under that mark-to-market.
Yeah, so when they make the mark-to-market election, it's pretty much letting the IRS know that I am a trader, and now I want to be able to claim some of my expenses for being a trader, which could be my software, commission fees, my home office if I want to. And now I can maybe even write off a vehicle if I'm using a vehicle in the capacity as a business owner. That's when we have to start doing some consulting with some of our traders to make sure that they're leveraging their business the right way.
Okay, so what if they are like a business owner and they have, let's say they have a marketing company, but their trading account is doing really well? Can they make that exemption as well? Is it an exemption or is it? Yeah.
Exemption.
Okay. So can they make that as well if they have like active income over here in their marketing company?
Yes.
Is this treated as an active investment?
It's only treated as an active investment if they choose to make that election. And you have to get to a certain dollar amount in your trading account and reach a certain status as a trader, even in order to make the mark-to-market election.
Okay.
As a new trader, you can't make the mark-to-market election.
Okay.
I believe the amount last year in 2022 was about $30,000 in your trading account. But I think that has then thus grown in 2023.
Okay.
And the reason why the IRS does that is they just want to protect traders. That's what they're trying to do. Because once you make that election, you can't unmake the election.
Okay. Got it. So that could potentially, instead of someone saving $3,000, right? They can now, if they have $500K in losses in a year, they can now have all the $500K instead of the $3,000.
That's 100%
yeah.
correct.
So that's massive.
Yeah, absolutely.
Okay. So then this is a question that we get a lot because we have, over 1,200 different traders that are in our community, and we have a ton of crypto investors too. So it's like, how people always ask, should I really be putting this in my own personal name? Like, should I have my investment accounts with whatever broker or offshore exchange that I'm using? Should all of that be inside of my own personal name? Or when is a good time to put it in an LLC or a C Corp or a trust? First of all, when should we do that? And then secondly, what entity is a good move to move the assets into?
Yeah, so when you're thinking about going into trading, you will start to realize like there's certain people that are using LLCs versus using their personal names and their own social security numbers. And this is something that you will have to decide when you decide to go into trading. Do you want to trade with your own social security number, meaning that if something were to happen, you're liable anything that you have is liable if something were to happen.
What's something that would happen?
So for example, we've had certain trading platforms go down, right?
Okay.
Certain people have lost assets or they've been sued by the trading platform for activity that they've done on the trading platform that was against the trading rules.
Okay.
If that ends up happening, you can end up being in a lawsuit and all your personal assets could be meant to pay the debts for that lawsuit.
Okay. Yeah. And like another example could be if you put your car under your personal name and then you get in a car accident and all of your trading accounts are in your personal name, then that person maybe that's suing you for that accident, whether it's your fault or not, anyone can sue. I could sue you for looking at me weird. Then that is now getting tied up in the lawsuit because everything is under your personal name.
Yes.
So
that's one of the benefits to having an LLC is you can separate the liability from yourself personally.
Okay.
So if Jeff goes and does something personally like getting into a car accident, his LLC is protected from what Jeff is doing personally.
Yeah.
Yeah.
Okay. So what's the amount of money that in a trading account that you would say, okay, it's probably time to put it into an entity?
I think somebody who's trading, who's serious, is somebody who's doing over 50,000 in their trading account.
Yeah.
That's when we start to look at setting up an LLC and getting it out of their personal name.
Okay.
One of the questions is like, okay, what do I do with my old account since I already had it set up? This is when most brokerages will require you to set up a new account because it is going to be associated with the EIN number instead of your social security number. So now it's like you're starting all over again inside of this LLC.
Okay, got it. And would you say that LLCs are the move, or when would you look at a C Corp and or even a trust structure?
Yeah. So the LLC is the move for most traders. And the reason why is because on the income that you're earning, you're not subject to Social Security or Medicare tax. So the LLC is the perfect entity. Typically, we switch people over to S corporations so they can take payroll. But again, you're not subject to Social Security and Medicare tax, so there's no need to draw out payroll from the S corporation.
Okay.
I like to keep traders inside of LLCs. We invite the conversation of the trust when it's time for estate planning and asset protection.
Yeah.
If you have a big estate or your estate's starting to grow, you should be looking at transferring those assets into a trust so they can be passed off to your beneficiaries. God forbid that car accident you get into, you actually end up dying. You would want that trading account to go directly to your children or to your heirs, rather than going to the banks and letting the banks decide how to disperse your assets.
Got it. And that's just through like a revocable trust?
Through a revocable trust.
And then let's say someone's, really high net worth, they got a couple million in their account. What's like an asset protection strategy that may be really wise for them to implement so that if something crazy happens, like they're protected even in the next level of just not having an LLC, you're taking it to the next level of someone that's really wealthy. What's something that you would maybe recommend for that person that's got a few million in their account?
They can start looking at irrevocable trusts too.
Okay.
If you start moving assets from your revocable trust into your irrevocable trust, no one can go and get those assets. I mean, there would have to be a Supreme Court ruling to try to get those assets out of your irrevocable trust. Like it's extremely, extremely hard. So when you start getting into like high net worth, and I'm talking about 2, 3, 5 million net, that's when we start looking at transferring assets out of the revocable living trust and start moving assets over into the irrevocable living trust because of your estate. If your estate starts to grow, you're going to start dealing with estate taxes when you pass away. So if you want to minimize your estate, it's a tax planning play.
Okay, got it. And is that onshore or offshore?
Typically, we like to do this stuff onshore, but if you would like to go offshore, you're more than welcome to. There are offshore tax professionals that will help set that stuff up.
Yeah.
It can be a little bit expensive, which is why the average person doesn't go down that route. You're spending maybe $200,000 to $300,000 to set all this up, and the maintenance for it to keep your attorneys intact with all your trust structures could be anywhere between $50,000 to $100,000 a year just to maintain those trust structures.
Got it. Okay. And any other wise words on the tax side, asset protection side for someone that's, got a successful business, they're now making money in investments? Yep. Is there anything else that you would have them look at other than the elections that we talked about and the strategy?
Fan of real estate.
Yeah.
I'm going to go there. I always like taking money and parking it into real estate because of the depreciation play.
Yeah.
I can get somebody to have depreciation on the tax return while also having an asset that can appreciate over time. I mean, that's a great way to build wealth and minimize taxes at the same time.
Yeah.
Most people are hesitant to go into real estate because they don't understand the tax matters around it and they don't want to manage a property. But if you can build a real estate portfolio in a specific way, you don't have to do a lot of management and you can claim losses just like losses from capital, losses from trading. You can claim depreciation losses against your active forms of income. I have certain traders, Jeff, who are doing, $1-2 million a year, but they're buying enough assets to offset the taxes that they would be paying on that income they're taking out of their trading account.
Okay, but here's the thing that people don't understand about real estate is you have to be elected as a real estate professional, which means that that's your primary focus above anything else that you're doing. So you're making that like your primary focus, is the real estate investment business. Now, you have a way to not have that be the case, right? So do you want to explain that really quickly on how someone could potentially use real estate without actually having to become a real estate professional to offset their active income, not just passive income?
Yeah, so the government created these rules called the passive activity loss rules. And essentially what it means that is if you have passive income, your passive income and your passive losses cannot offset your active income. But there is a rule that allows for you to get around those passive activity loss limitations.
Okay.
And the rule is if you're running a rental property operation that's a short-term rental, and each person that you have inside of your short-term rental is only staying in the property for 7 days or less, so average 7 days or less per customer, and you're managing that short-term rental just for 100 hours in the year.
Okay.
You can use the same strategies that a real estate professional can use to accelerate depreciation and create those losses as active losses against your other active forms of income.
Okay.
Now, to understand what the real estate professional strategy or real estate professional status is, a real estate professional is someone who's spending 750 hours managing their real estate operation, and they're spending half of their time in real estate than any other active job, which is really hard for somebody to do. This is why I like the short-term rental strategy, because it gives the person the ability to have a short-term rental property that they're only managing 100 hours in the year, and then they can benefit from the cost segregation study.
Nice. Okay. And the other thing that I really, really like is the foundation thing that we were talking about earlier. Why don't you mention that real quick? Because everyone's probably heard of like the Clinton Foundation and all these elites using these like family foundations that are doing all these great things in the world, but in reality, they're also doing it for the tax benefits, right? So what is this whole foundation structure, and how can someone actually like utilize that? And what are the nuances? Because you do actually have to donate money. It's not like you're just, siphoning money over here and just
controlling.
Yeah.
That's the part that's really
so explain this like structure real quick.
Yeah, so the Rockefellers have done this, the Bushes, the Kennedys, the Obamas, pretty much anyone of status is leveraging these foundations. And how they leverage the foundations is once you set up a private family foundation, it is for your family, but it's a philanthropic entity. The government will allow for you to donate up to 30% of your adjusted gross income every single year to your own private family foundation and a tax deduction. The money is in your control. It's your bank account. You can disperse it.
So if you made $1 million, you can take up to 300 grand into the foundation, and that's a write-off against this entity.
Yeah.
Okay.
That could be easily $100,000 of tax savings right there.
Yeah.
And then now the money is sitting inside of your foundation. And the one rule that the foundation has that allows for you to keep your foundation status is that 5% of the assets in the foundation have to be donated to another 501c3 or a qualified entity of your choice. But that other 501c3 could be another family member's charity. This is how most high net worth families keep money within the family. They're donating to their own foundations, and then that foundation is donating to other charities that family members are a part of.
Okay. Now, but do those charities like make investments, generate profit? Or is it all just philanthropy?
No, it is not all philanthropy.
Okay.
Inside of the foundations, you can invest the money. So you can literally invest in stocks, crypto, artwork. And one of the benefits of the foundation is there's actually no capital gains tax inside of the foundation. And so some people will go and buy artwork for their business, which is a tax deduction, then get that artwork appraised, right? Maybe for 20, 30% higher than what they bought it for, and then donate it to their foundation and receive that second tax deduction right then and there.
Okay.
Right.
Nice. Okay, but then how does someone actually benefit from that? Obviously, it's great to donate money to different causes, whether you're doing 5% or more or whatever, right? But then they make investments. How do they actually get paid? Are they put on salary on that foundation? And what if they wanted to make more money from that foundation?
So the foundation is allowed to hire employees just like a normal business owner is allowed to hire employees for an LLC or an S corporation. Inside the foundation, if you hire your family members, these family members might have lower tax brackets than you. Now you're doing what's called income shifting strategies. I'm shifting income into my foundation, hiring my children, and then shifting income downwards to them. Right? Who maybe have way lower tax brackets and probably lower salaries than maybe that person that's creating the foundation at the top. And this is how most generations are able to pass down wealth, is through these foundations and through, of course, trust and other investments.
Okay. So then they're putting it on salary. What about like, do they ever take big distributions from that foundation?
If you take a distribution, it is considered taxable income, but it's not against the rules of the foundation. We just need to make sure that if you're taking the distribution, how are you going to offset the tax?
Okay. But so one of the main strategies that ultra high net worth use, which isn't a secret, is that they use debt, right?
Yeah.
They take out debt because it's non-taxable and the interest is a write-off on the debt.
That's correct.
So do people then, instead of, taking the distribution out, they take a loan against the foundation?
You can.
Yeah.
You can take a loan against the foundation's assets with a promissory note, but that loan that you take from the foundation has to go towards things that are going to eventually help that foundation.
Okay, got it.
You can't just take the money out and go spend it on luxuries and vehicles and cars. You actually need to do something that's going to eventually benefit that foundation.
Okay, awesome.
Yeah.
Great. Well, I think that is very, very helpful. Any other last words for the dude that's working to become a millionaire or having success trading? Is there anything else that you would recommend that they do or look into?
Just remember that taxes is your biggest expense.
Yeah.
The more you avoid it, the more it will cause you to have pain in your life. I'm telling you, the people who find success the fastest are the people who partner with professionals the fastest.
Yeah.
So if you can find a professional that can teach you how to avoid taxes legally, then you can get to where you want to go a lot quicker. It's just like hitting the fast button on the treadmill. If you have the ability to control the speed, you have the ability to get in shape fast.
Nice. Where, if someone wanted to learn more about everything we just talked about and about what you do, where would they find you?
Oh, we're on YouTube, we're on Instagram. You can DM us, send us a message, and we'd love to help you out. Schedule a free consultation with my team.
Which is just your name, at Karlton Dennis?
At Karlton Dennis on
Awesome.
all platforms.
All right, great. Appreciate it, brother.
Absolutely.